G'day guys, and welcome to another episode of the Aussie Dividend Machine. In this portfolio update, we'll be having a look at my latest portfolio purchase. We'll be looking at the situation with China and Australian wine. It's earnings season, so we'll have a look at how some of the stocks in my portfolio have performed in the latest earning releases. We'll also do a deep dive on one of my stocks, which is Transurban. That was requested by one of the subscribers, so we'll drill right into the details of Transurban and see why I made that purchase. And then finally, guys, we'll give you a sneak peek at my portfolio earnings to date. We've been going for just under a month. I'll do a full in-depth look at that 1 month stage, but just for the sake of this video, we'll have a sneak peek at the earnings so far. Make sure you stick around till the end of the video for that one. Now, as always guys, please note this video is not financial advice. Guys, these videos are for your entertainment only. Please go and see a financial advisor before making any investment decisions. Okay guys, let's jump straight into the update. This is the stock that I purchased this week. It's called the Vanguard FTSE Asia Excluding Japan Shares Index ETF. It's a bit of a mouthful. It is an index traded fund and it tracks the Asian market excluding Japanese shares. Now, as always guys, I did my NAV check on this stock before I made the purchase. If you don't know what that is, make sure to check out my ETF video. I'll put that up on the screen for you to have a look at. Okay, so moving down the page, we can have a look at the top holdings for this ETF. This is the most interesting part for me and the reason I chose the stock. You can see here the top 10 holdings. The biggest holdings are Alibaba, Tencent, Taiwan Semiconductor Manufacturing, and Samsung Electronics. These are all great Asian companies which have super high potential for growth. The reason I really like this ETF is that it gives me exposure to emerging markets. This exposure is gained without having exposure to the US market at the same time. If you guys have been following the channel, you know that I've got a separate ETF in my portfolio that tracks the S&P 500. The S&P 500, as you guys probably know, is so great because it holds some of those big American tech companies like Facebook, Microsoft, and Apple. The benefit of having this ETF is if that technology bubble in the US blows, I've still got all these other great holdings still there in my portfolio as a backup. Okay, coming back up the page, we can actually see that the dividends on this stock are paid quarterly, which is a great idea for cash flow. Another reason why I really like this ETF. Okay guys, onto the Invest Smart homepage now. We can see my net worth has gone up to just over $12,000. You can also see that latest purchase of VAE up there at $70.41. Overall, the portfolio is looking pretty good, slowly growing. Hopefully we'll see that develop over time. Okay guys, so just jumping into our first topic for today, the article I wanted to have a look at is called China's Targeting of Australian Wine Politically Motivated. As some of you may have heard, China has moved to levy heavy import duties on Australian wine. There's a lot of people saying this is politically motivated. I mentioned this could be a potential risk in one of my earlier videos. That video was about the South China Sea and rising tensions between Australia and China. I mentioned 3 stocks in that video that I thought were at risk. Those 3 stocks were A2 Milk, Treasury Wine, and BHP. Now, while I think that BHP has probably not as much of a risk as I thought they were, considering that China is so dependent on Australian iron ore. However, the other 2 stocks I genuinely still believe could be at risk of China making a policy decision or something else to impact the way that product is sold in China. And here we can see today, Treasury Wine Estates, Australia's biggest winemaker, fell as news of the investigation began to leak and were briefly halted on the ASX. They were down 13% at the time of this article being published, and I think by the end of the day, they were down 16%. The other share I mentioned in that video was A2 Milk, and I would be worried if I was holding A2 Milk at the moment because I think they face the same problems if China decides to put a tariff or an import tax on the sort of products that A2 Milk sells, which is your infant formula or fresh milk or whatever they're selling to China. So that's one to watch, guys. I'd probably recommend getting out of Treasury Wine if you do hold shares in that company, and if you are thinking about buying them, I'd say just hold off. Okay guys, so on to the next article. This one also in the Australian Financial Review is called Beach Energy Avoids Write-Downs, Introduces Climate Target. So for those of you following the portfolio, you'll know that Beach Energy is one of the stocks that I hold. The reason I purchased Beach is because I thought they were quite good value, especially after the oil price has recently hit the floor. A lot of people were expecting Beach's earnings to be quite low, considering this drop in oil price. In this article, we can see revenue from the company's gas business covered all of the group's operating and stay-in-business costs. This means that the company didn't lose money and they were still able to pay the dividend that they've promised shareholders. So having a further look down the article, we can see none of Beach assets have been written down because they are sustainable at lower commodity prices. Essentially, their CEO is saying that they forecast price drops like this and that they are resilient enough to withstand them, especially with their gas production unit picking up where the oil production has fallen over a bit. Checking out Beach's stock price, we can see that it's made a small loss, nothing too major, certainly not as big as some of the big miners or some of the other big oil producers. So I think this stock has still been a good pick. They've shown a little bit more resilience than everyone thought they would, and it's one I'm definitely going to hold on to. Okay guys, on to the next stock I wanted to have a look at, and that's GMG or Goodman Group. This article reads, Goodman surges to new heights as COVID-19 boosts warehouse demand. Now this result, I think a lot of us could have forecasted. Goodman has done exceptionally well, especially during the pandemic. We can see on this price chart just how well GMG have done. They've made some huge gains since the bottom of the market crash, and now they're up well above where they were pre-pandemic. So the key points why I like GMG, especially after these results have been released, they are that they've increased their assets under management by 12%. They're directly engaged with e-commerce, especially going forward, and their stock price has hit a new high. The other super good point about GMG is that they essentially have no competitors. They've got a really strong moat, and for this reason, I'll be holding GMG and probably increasing my position in this company going forward. Next, let's move on to Crown. This article reads, Crown confident that casinos can rebound after restrictions. Crown has taken a pretty big hit on their earnings. Crown has reported a net profit decrease by 80.2%. However, their profit has not diminished. Their profit was still 79.5 million. This is really important because a lot of companies are currently reporting losses during this reporting season. How has Crown achieved this? Well, it's a couple of reasons for it. First of all, they've stood down 95% of their staff. And they were able to do this because of government support in Australia like JobKeeper, and similarly in New Zealand, other government schemes have helped with being able to lay off employees without them losing all of their income. Here in the article, we can see how the importance of JobKeeper is highlighted, especially with that high percentage of people being stood down. It's also highlighted in the article that their new casino in Sydney will likely employ about 2,000 people once it's open and operational. This is a huge plus side, and I think it will generate a lot of momentum for the company once that casino does open. So the key reasons I like Crown and will continue to hold the stock and potentially buy some more. They've taken a big hit to profits, but they haven't made a loss. They've been agile and have been able to stand down staff to maintain their bottom line. They've had one of their key businesses in the Perth casino reopen and show that revenue is coming back into the business. I think these are strong fundamentals, and there's some good reasons why I'll be holding on to Crown and looking to increase my position going forward. Next up, let's take a look at Transurban. A deep dive into Transurban's fundamentals was requested by one of the subscribers to this channel. Transurban develops, owns and operates tollways in Australia and overseas. They do this by either fully or partially funding major infrastructure projects. Once they're complete, they normally take a long lease from the government in order to own and operate the road. In this period of the lease, they charge a toll that everyone who uses the road pays. So while there is quite a big upfront cost to complete the project, the dividends continue to pay for up to 50 plus years. So when we have a look at Transurban's balance sheet, we can see the following. They've got really high levels of debt. They've got high construction costs, over $1 billion, which is more than 40% of their revenue. They've made a loss in the most recent year, but they've still paid a dividend to shareholders. Now, this can be seen as good or bad. Failing company that pays a dividend is a really bad sign. This is because they're most likely using debt to finance the dividend payment. Now, I've got a feeling this is what Transurban's doing, because as we know, they've made a loss this year. However, Transurban is known for a good dividend payout. In order to not lose shareholders, I think it was essential for them to pay this dividend payment. Another note on their balance sheet is that they have been issuing more shares to shareholders. In essence, this dilutes the value of the stock, meaning that the value per share goes down because more shares are being issued. So you might be wondering, all of these balance sheet metrics sound pretty bad for Transurban. So what has motivated me as an investor to purchase Transurban in my portfolio? Well, the biggest thing for me is the intangible value that Transurban holds. The first intangible that I think is super valuable is the fact that Transurban are trusted by governments around the world to plan, build, and deliver major infrastructure projects. This is a space where not many companies operate. And if you gain the trust of the government to operate a toll road, then likely you're going to keep receiving contracts. This is exactly what we've seen happen to Transurban in Australia. They own and operate so many different toll roads over the country, and they've got even more in development. Now, the other item to touch on is their high debt level. I think high debt levels for a company generally are not desirable. However, in this case, I believe it is essential for Transurban to carry high debt. The projects they're constructing are projects that sometimes the government doesn't even have money to fund. For this reason, I would expect them to have high debt levels. I think the nature of their work requires a large upfront capital payment, but then the dividends that pay over the next 50 years are ultra valuable. That brings me on to my third point. I'll put up on screen now a list of Transurban projects that are still under construction. As you can see, compared to the ones that are currently under operation, there's a huge amount of work in the pipeline. Once these projects come online, I would expect one, the construction costs to go down for Transurban, and two, I think that their revenue will continue to increase as more and more people use these toll roads. So for me, yes, I'm happy with my purchase of Transurban. I think they're a long hold company. At face value, the stock can look unattractive, especially if you're only looking at the balance sheet. But once you understand the fundamentals of the business, I think you can gain a lot more respect for Transurban and what they do. I'm hoping this stock can deliver my portfolio great returns over the next 10, 20, 30, and even 50 years. So guys, here we can see a quick snapshot of my profit and loss in my portfolio so far. We'll go over this in more detail next week in the portfolio update then, but I just wanted to show you guys a quick snapshot of exactly how I was doing. As you can see, Goodman Group is my number one performer, closely followed by Crown. They're two shares we've talked about in this episode, so have a look at them for yourselves, guys. You might decide they're worth investing in. As always, make your own decisions. Well guys, that's all for this week. Thank you very much for watching. As always, I really enjoyed making this video. If you're enjoying the content, make sure to subscribe and please give the video a like and help grow the channel. Until next time guys, stay safe, take care, and cheers.